Hello everyone, welcome to my channel. Today I'm going to talk about tax write-off that got people in trouble. Tax deductions can be a powerful way to legally reduce taxable income and keep more money in your pocket. Business of owners, freelancers, and self-employed individuals often rely on write-offs to lower their tax bills and improve cash flow. However, not every deduction is legitimate. Every year, taxpayers get audited, fined, or penalized because they claimed questionable tax write offs that either stretched the rules or clearly violated IRS guidelines. While some mistakes are accidental, others come from bad advice, poor record keeping, or understanding what qualifies as a deduction. Understanding which write-offs commonly trigger IRS attention can help you avoid costly tax problems. Writing off personal expenses as business expenses. One of the most common tax mistakes is claiming personal expenses as business deductions. Examples include family vacation labeled as business trips, personal groceries claimed as office meals, clothing that is not required for work, personal vehicles used without proper mileage tracking. The IRS requires business expenses to be both ordinary and necessary for your industry. Trying to disguise personal spending as business expenses is one of the fastest way to attract audit attention. The second thing is the luxury vehicle deduction abuse. Business vehicle deductions are legitimate, but some taxpayers abuse them by claiming expensive luxury vehicles primarily used for personal reasons. People sometimes attempt to write off luxury SUVs with little business use, claim 100% business usage inaccurately, deduct personal commuting expenses. If audited, the IRS may request mileage logs, business purpose documentation, maintenance records, trip details. Right without accurate records, deductions may be denied. The third thing is home office deduction mistakes. The home office deduction is legal, but it is frequently misunderstood. To qualify, the space must be used regularly for business, used exclusively for business purposes. Some taxpayers get into trouble by deducting shared living spaces, claiming entire home unnecessarily, extra, ex, exaggerating office square footage. For example, using your dining room table occasionally for work does not typically qualify as a dedicated home office. The fourth thing is excessive meal and entertainment deductions. Meals connected to legitimate business activities may qualify for deductions. However, taxpayers often push the limits by claiming family dinners, entertainment outings, personal celebrations, luxury dining without business purpose. The IRS expects documentation that shows who attended, the business purpose, date and location, among spend. Large or excessive meal deductions compared to income may raise red flags. The fifth thing is fake business losses. Some people create businesses primarily to generate tax deductions rather than actual profits. Examples include hobby businesses consistently losing money, side businesses with no genuine effort to earn profit, businesses created solely for deductions. The IRS has hobby laws, rules that prevent taxpayers from deducting ongoing losses if the activity is not operated with a legitimate profit motive. If the IRS determines your business is actually a hobby, deductions may be disallowed. The sixth thing is inflated charitable donations. Charitable contributions can reduce taxes, but inflated deductions often lead to problems. Common issues include overvaluing donated items, claiming donations without receipts, inventing charitable contributions, donating non qualified property. The IRS may require donation receipts, appraisals for valuable items, written acknowledgement from charities. Large charitable deductions that seems disproportionate to income can trigger scrutiny. The seventh thing is writing off pets as business expenses. This unusual deduction has become more common online, with social media influencers sharing questionable advice. Some people attempt to deduct pets as security systems, mascots, emotional support animals for productivity. While rare situations may qualify legally, most pet related deductions do not meet the IRS requirements. Trying to write off everyday pet expenses without clear business necessity can create serious audit risks. The next thing is claiming excessive travel expenses. Business travel deductions are legitimate when properly documented. Problems arise when taxpayers extend vacations but deduct the full trip. Include family expenses. Claim luxury accommodations unnecessarily. Lack documentations for business activities. The IRS closely reviews travel deductions because they are commonly abused. Maintaining detailed records is essential. The ninth thing is wrong numbers and estimated expenses. Many taxpayers make the mistake of estimating expenses without proof. Example, claiming exactly 5,000 in supplies, listing large rounded numbers, deductions repeatedly, guessing mileage total. These patterns may appear suspicious during an audit because, because legitimate expenses usually vary. Good bookkeeping and documentations are crucial. The 10th thing is the social media tax hacks. One growing problem is people following tax advice from social media influencers who are not qualified tax professionals. Online creators often promote questionable deductions, aggressive loopholes, misleading write off secrets, risky tax strategies. Unfortunately, taxpayers, not influencers, are responsible for the accuracy of their tax return. Following bad advice can lead to IRS audits, penalties, interest charges, tax fraud investigations. Why the IRS pays attention to certain deductions? The IRS uses automated system to identify unusual tax return patterns. Red flags may include excessive deductions compared to income, high business losses, Unusually large charitable contributions, repeated losses year after year, lifestyle inconsistent with reported income. This does not automatically mean you will be audited, but aggressive deductions increase risks. How to protect yourself? The good news is legitimate deductions are completely legal when properly documented. To stay safe, keep organized records, save receipts, track mileage accurately, separate business and personal expenses, work with a qualified tax professional, avoid aggressive, too good to be true strategies. The goal is not to avoid deduction, it's to claim them correctly. My final thoughts on this is tax write offs can save significant money when used properly, but abusing deductions can create major financial consequences. Many taxpayers get into trouble because they misunderstand IRS rules, extravagate expenses, or follow risky advice online. The IRS allows businesses and individuals to deduct legitimate expenses, but documentation and honesty matters. Smart tax planning is about staying compliant while maximizing legal opportunities, not trying to cheat the system. In the end, accurate bookkeeping, good records, and professional guidance are some of the best protections against tax trouble. Thanks for watching this video and do not forget to subscribe to my channel.